Good evening and welcome to this 80-20 approach to trading by myself, Charlie Burton, in conjunction with Tickmill. As usual, with any official presentations such as this, we'll just read out the risk disclaimers. So the material provided is for information purposes only and should not be considered as investment advice. The views, information and opinions expressed in the text belong solely to the author and not to the author's employer. They're not my employer, but this is just a normal text. Organization, committee, or another group or individual or company. Risk warning: CFDs are complex instruments which come with a risk of losing money rapidly due to leverage. 75 to 74% of retail investor accounts lose money with trading CFDs, etc., etc. So there's your risk disclaimers. Let's get into the presentation. So the 80-20 approach. Well, we're going to be talking here this evening all things 80-20 in the realms of trading. And the first one, as I've put up here at the top, is that traders spend 80% of their time looking for a technical solution to their psychological problem. What I see, over and over again, I've been trading for 27 years. I manage 5 different funds. I've won trading competitions. I've been on TV, on BBC. I've been all over the place over the years. And I've coached traders for the best part of the last probably 19 of those 27 years. And in my experience of meeting traders and whether it's at trade shows, webinars, anything like that, trading rooms, then what I find is that most traders spend a lot of their time looking for a technical solution, but they are usually their own issue. So that's what I'm saying there. There's a psychological issue that they're not addressing. So, for example, just a very, very easy example here is you imagine a trader has a strategy, they find a strategy, devise a strategy, it starts off trading okay, has a couple of winners, has a few losers, and then all of a sudden they're off looking for the next strategy sort of thing. They're binning that one and moving on to the next one. Whereas this strategy itself might actually be nothing wrong with it, or their approach. There might be nothing wrong with their approach, but it could even be that they get bored. Oh, there's not enough trades, right? I'm off. I'm going to go and do something else. So they're always looking for something else technically, and yet it's really more to do with them than anything else. So that's the first point to mention, because what we're looking to do in this presentation is to look at what those majority of traders do, the 80% of traders, what they do. Bearing in mind, 80% of traders lose money. So if we can identify the things that they do, because these 80% of traders out there that lose money, if we can identify the things that they do, then looking at their habits will help us to determine what successful traders should be doing. So basically, looking at what they do the opposite. And one of the things that they do, as I've already highlighted, is they spend too much time chasing the next technical strategy or method or whatever, and not enough time looking at their mindset. If you take professional sports, for example, professional sports people place a huge emphasis on developing an elite mindset, and yet in trading, people don't. So you take any elite professional sport, take golf, for example. Most golfers, their caddies are trained psychologists, sports psychologists. So they've got their sports psychologist is walking around with them. You look at any sport and they have psychologists that work with them. And yet in trading, people understand that there's an element of mindset to trading, and they might read a trader psychology book or two, but that's at the max. And then they think that they don't need to do anything more. So my sister-in-law, for example, she was an ex-Olympic speed skater. She got a silver medal in one of the Olympics. I think it was in Canada. And when I've talked to her about when she would enter a race, like that. So it was, speed skating. I don't know if it was 1,500 meters or what she was doing. When she was stood on the line, she said what she would be thinking about is not, oh, what if I win? What if I lose this race? She'd be focusing on once that starting gun goes, where the first step of the blade of her boot, how it would hit the ice in front of her and where exactly it would hit the ice in front of her. That's the level of detail that they'd be going down to just in her sport. And then, of course, then she'd be focusing on the next step and the next step. Rather than thinking about the end and the end result, she's thinking about the process, just following her process. And that's just one element of what professional sports people do, and one element of what obviously traders should do. So we've got to try and embrace a lot more of that and focus a lot more on the mindset side of trading and not chasing the holy grails of technical trading strategies. So let's move on. Okay. Right now, I'm going to give you 5 simple mindset techniques that you can take away and use with your own trading. During this presentation, we're also going to look at a coin toss experiment that I did several years ago. We'll explain the reasons for that. We're going to look at the world's very best traders and some of their typical traits. And I'm going to end up with a few interesting charts to finish off with you. So let's go into, first of all, self-talk. Now, self-talk is something which is really, really important in your trading. You imagine if you were sitting there at your desk trading and you had a mentor or just another trader sat next to you, they would be talking to you. When you're about to take a trade, it's likely they'd be saying, why are you taking this trade? And you would be having to talk out loud, explaining to them what you're doing or what you're about to do. Now, psychologists have proven that when you talk out loud, so here's if I can draw a side profile of someone, that's not bad actually. Put a bit of hair on, and that's not too bad. And maybe an eye would be useful, and there's the mouth there. So when you talk out loud, it fires different neurons in your brain, neural pathways in your brain, to if you just internalize everything. So when we're sat there trading by ourselves, what are we doing? We're internalizing our thought processes. And yet if we talk out loud, then we're firing different neural pathways. If we fire the different neural pathways, we may get a different answer back, just like if we were talking to someone else, if they were in the room with us. So that's a really powerful tool to talk out loud. For example, here's some lines that you can use. If I take this trade right now and it fails, will I kick myself? So this is self-talk now. So a lot of people so often will take a trade, and if the trade rolls over and stops them out, then they get frustrated or upset. Well, you should never get frustrated or upset just with having a losing trade, because a losing trade should still be a good trade. If you've taken the right type of analysis, you followed your method, then just the fact that it's lost does not mean it's a bad trade. So, however, what a lot of traders do is they do take bad trades. They jump around, they chase markets when markets are flying in one direction or another, and then that's when they take a trade, and if it fails, they will kick themselves. So a really good arresting mechanism, sometimes when you're tempted to take a trade which doesn't quite meet your rules, is just to ask yourself this question. If I take this trade right now and it fails, will I kick myself? Because the answer will be there. Because the answer will come back, if I take this trade now, I'm trying to force this trade. No, I won't be happy. Right, great. So it acts as an arresting mechanism. So we start to apply this self-talk into our day-to-day, week-to-week trading. For another example, I was stopped out only for price to go in my intended direction. Well, at least my analysis was correct. Now, this is an interesting one of self-talk, because it's always frustrating when you get stopped out only for the market. So the market comes back a little bit, maybe stops you out here because your stop loss had been moved or whatever, only for price to then go higher. And then, of course, a lot of traders out there think it's a conspiracy and or will get frustrated because they'll see price go higher afterwards and then will be angry and frustrated about a situation like that. Again, what we don't want, what we're trying to do with trading and our emotions is not to have a big emotional range. So if we're going from delight and euphoria up here, euphoria, if I can write here with my mouse, to frustration down here, well, we don't really want to have these big swings in emotions. What we actually want is a desensitized emotional range. Is it almost impossible to be emotionless in the in our trading, but you can certainly desensitize, and it's using tricks and self-talk like this which can help. So this is a good situation of turning a negative situation into a positive, where you were stopped out only for price to go in your intended direction. Well, and you can say, well, at least my analysis was correct. I'll give myself a pat on the back for that, because the analysis is correct. If I took 100 trades like this, then of course there's going to be instances like this one where I'm just going to get stopped out only for it to carry on in my direction. But out of those 100 trades, there will be plenty that will work. So actually, I'm quite pleased to see that the market did continue to carry on going up. What you've done there is you've not allowed yourself to then get frustrated and angry. You're turning at what potentially could be a negative emotional reaction into a positive. Okay, let's move on. And I would urge you to write these down, because you can use these in the context of different trading situations. It's just a case of moving a few words around. So here's another one. I hesitated on taking an entry and it's become a winner. So I completely missed out on this winning trade, and it's become a winner. And here's the line. That trade obviously didn't belong to me. Okay. So there's an issue here, because the person in this situation hesitated on taking a trade. Okay. So that's the root of the problem, that the trader didn't take the trade in the first place and hesitated on it. But again, the fact that the market's gone up in the intended direction, don't allow yourself to get frustrated about that, because that trade didn't belong to you. If you couldn't bring yourself to take the trade in the first place, it obviously didn't belong to you. And, okay, right, I need to work on my mindset as to why I hesitated in the first place. So rather than, you see it all the time, I see it all the time, traders will get angry and frustrated, saying, oh yeah, I knew that one was going to go up, but I hesitated and now I'm really frustrated. Well, again, turn it into a positive. That trade didn't belong to you. Another one will do. In the meantime, you need to work on your mindset on why you hesitated. You see what I mean? We're turning negatives into positives in these sorts of situations. I missed out on a great run, but at least my analysis was correct. Again, we've sort of covered that one off earlier as well. So even if you miss out on a complete, really great run in the market, for whatever reason, again, give yourself that pat on the back to say at least your analysis was correct. And this last one, this trade is simply the next trade of the next 1,000 trades that are going to come, the next 10,000 trades that I'm going to be taking. So there's no need to place such importance on it. We all are victims of this to some degree or another, that we will place importance, a huge amount of importance on that very next trade that we're taking right now. But we need to, again, desensitize the level of importance we're putting onto it. And if we remind ourselves, look, this trade that I'm in now, it's just the next trade of the next 10,000 trades I'm going to be taking. So is its outcome in the grand scheme of things over the next 1,000 trades or more really that important? No, it's not. So again, that's just a few tricks there, a few mindset tricks for desensitizing the emotional range. If you can desensitize your emotional range, then you don't carry that emotional baggage into the next trade. That's what we're trying to do here, is from trade to trade to trade, we want to go into the new trade with no emotional baggage from the last ones. And so if we can deal with the last ones and all those potential negative emotions that you can feel, then we're better prepared, better set for the next trade we're going to take, which means that we're going to trade it better. That's what it's all about. We'll trade it better. We won't jump out early and bank our profits long before our designated, our preset target, and we won't micromanage our trades too much through fear. All of those things which are based on emotions, which is what those 80% of traders out there are doing around the world. We need to try and find a way by using mindset and self-talk to minimize that emotional range. We do that and you're on the right path. Okay. I will come to your comments in a minute. I'm not reading them at the moment. I can see there's some comments coming through. I will come to them. So all the other above points are there to help reduce that emotional range. Right. Okay, let's move on here, because this is something which will help at the back of your mind as well, to everything towards trading. Right. This coin toss experiment. I did this coin toss experiment with a number of traders several years ago. So what we did is, we used a randomizer. To basically say whether we're going to go long or short. It was based on the S&P or the Dow, one of those two at the time. And literally, so effectively, we were throwing a coin in the air and it would tell us whether to go long or short. Okay. No technical analysis at all. And it was based on, like I said, on the US stock indices. And I think the long signal was, or short signal was enacted upon half an hour after the market open. All right. So every day, a random coin toss to decide whether to go long or short. And so this whole experiment was literally about seeing whether you could use no technical analysis whatsoever, no method, no strategy, nothing, but a random coin toss and a bit of risk and reward and risk management. So it had a stop loss based on the average true range. I think it was based on about 60% of the daily average true range. And it had a target of 4.5 times the size of the stop. So 1 to 4.5 risk to reward. So we ran this as a test over a 12-month period and tested it 20 different times over that 12-month period. Because you imagine, if you do it once over the 12-month period, so every day the randomizer will say, right, long today or short today. You do that once over 12 months, well, you set the randomizer again over that same time. It's going to come up with a completely different sequence again. So the first sequence might look like this. Long, short, long, long. The next time you run the randomizer, it could be completely different. It could start off with short, long. You see what I mean? So it's a completely random. So because of that, we ran it 20 times just to prove beyond reasonable doubt over a 12-month period that it is possible to make money on a coin toss. Okay. So the on a £1,000 account on this, the average profit was £500 based on risking 1% per trade. So that was across all 20 instances of 12 months worth of trading that we tested. So it was really quite an incredible experiment, really. So that was the average profit. There were times when the profit was about 100%, and there was a year where it literally made £3. So the actual range of years was from £3 profit at the end of the year on one. Another one made over £1,000 profit, and there was plenty in the middle as well. But the point was, can you make money with just good risk to reward? Yes, you can. Now, the downside to this, the typical win rate was 25%. A lot of traders don't like low win rates. The maximum drawdown of all of those 20 instances was 30%. So the worst drawdown across all of that testing was 30%. So what can we glean from this experiment? Because I wouldn't want to trade with a coin toss. A drawdown is a losing period, Johan, a peak in equity from your peak equity to the trough in equity, to the low in equity. So if your equity's been rising and then it has you have a series of losing trades or more losing trades than winners, which creates your equity in your trading account comes down. That's what we call a drawdown. And so the peak equity high to the low in equity, the worst. What was the worst drawdown in this experiment? It was 30%. Okay. Like I said, though, would you in actual reality want to trade with a coin toss? Even I would. So I wouldn't want to trade with a coin toss just to tell me whether to buy or sell, with a few rules, yes, but no. I'd want to have a bit more involvement in the trading than that. So the experiment itself was really about just proving to people, don't get too caught up in all of the technicals, because with a good risk to reward, you can make money. Right. We'll keep that in mind and we'll carry on. So, like I've already said, most of us would never actually trade based on a coin toss. So what good is it? Well, it's that reminder that a decent risk to reward, traders can be highly profitable even with a low win rate. So my point is, spend less time worrying about win rate and more time on overall profitability. But this is probably one of the biggest things that I come across with traders over the last 19 years that I've worked with traders, is the fixation with trying to be right. And it's a human thing. We go through schooling, we go to university, we go into the working world being taught that being right more often is a good thing. Pass exams, get a higher exam rate, get a higher pass rate. We're trying to be right all of the time. And then we get into the trading world and we're told, well, actually, you only need to be right, let's say 50% of the time or less even. And so for a lot of humans, that's quite difficult to accept that means we're going to be losing 50% of the time as well. But with risk to reward, it doesn't matter. But still, nevertheless, traders are constantly seeking the holy grail of trying to be right more often. So if you can spend less time worrying about win rate and more time looking at overall profitability, it will help allow you to let go in your trading and spend more time on trader mindset than worrying about whether your next trade is a loser or not. Okay, so let's actually have a look at some of the world's very best traders and their average win rates that were recorded at various times. Paul Tudor Jones. probably the most famous trader of all time, one of the most famous traders, certainly of the modern era of the last 40 years. And if you don't know who Paul Tudor Jones is, you really need to go and look him up. His average win rate through the 90s, 35%. Jim Simons, the head of Renaissance Capital, billionaire. So is obviously Paul Tudor Jones. Renaissance Technologies, the most successful hedge funds of all time. Average win rate 50%. Richard Dennis, many of you will have heard of Richard Dennis. Richard Dennis was the chap who devised the whole turtle trader experiment. If you've never heard of the turtle trader experiment, I urge you to go and read The Complete Turtle Trader. It's the book that was written by I've forgotten the author's name now, but it was The Complete Turtle Trader was written about this experiment that took place in the early 1980s. Richard Dennis and his business partner put an experiment together to take people off the street and teach them how they traded. Richard Dennis at that time, I think, was worth over $100 million. And yet his win rate around about 30%. Jerry Parker, who was one of the Richard Dennis's original turtles, one of the original people within that experiment. He's head of Chesapeake Capital to this day, and his average win rate, again, around 30%. And yet, retail traders obsess with trying to be right and having trading strategies with 80% win rate, 70%, and yet the world's wealthiest traders tend to, on average, have lower win rates. So again, it's that whole 80-20 thing. Think about what the masses are doing out there. We know that the masses, more retail traders lose than traders who are profitable. So what are the things that the retail traders who are losing money doing? One of which is they are trying to be right all of the time. And one of the ways that they do that is that they don't use stop losses, and they bank their profits way too early. So their risk to reward is all skewed because they're trying to just, look, I'm in profit. I'm going to bank it. I don't want it to roll back over against me, so I'm going to bank it. So there's no given strategy per se with their approach. I can see that there's a lot of comments coming through. I will come to all of your comments and questions. I'm just going to carry on through this while I'm on a roll. Otherwise, I'll get distracted. So let's talk a little bit here about why so many trading strategies fail. Has anyone ever been on a social trading platform and think they found the holy grail strategy? You've been on a social trading platform and you've seen some trading strategy with this amazing equity curve doing something like this. And then when you've gone into it, you've then followed this trading strategy or whatever, and then it's just been going down whenever you've been in it. Yeah. A lot of that is down to those types of things are very often generated that in order to create these equity curves like this, they are very often mean reversion strategies using no stop losses and adding into losers. So which will work and create a lovely equity curve for a period until it stops working, until it gets into a trade whereby the market just keeps on going against it, and then all of a sudden it just crashes and burns. So that's fairly typical of what goes on out there. So why did most fail? Well, most traders fail, as I've already said, because they don't mean to do it, but they end up with inverted risk to reward ratios, which is the opposite of those world's top traders. They tend to have inverted risk to reward ratios. I'm not saying you can't make money with an inverted risk to reward ratio system if you've got a very good system, But I'm talking about for the masses, why do they lose? And we see it, and we have the data, and the data comes from brokers all around the world. And the number one reason why brokers' clients lose is they bank their profits too soon. So they bank too soon, and they either have relative to their stop losses. So the stop losses are miles away. Nothing wrong with stop losses being a long way away, provided you're going to get the risk to reward. So your target needs to be a long way away as well. Or they don't use stop losses at all. So when a market rolls over, then they can get themselves into a lot of trouble because they don't use stop losses at all. That is the number one reason why retail traders fail. So again, do we want to trade like retail traders, or do we want to trade like some of the world's best? There we go. Oh, okay. So I've already covered that off. Another thing that reason why a lot of strategies fail. So a lot of people, back test a strategy, and they say, "Oh, I hear this a lot," and people will say, "Oh, well, I back tested this strategy over the last 3 years, and it was really good. And then I started trading with it on a live account, and it just lost money." Why is that, Charlie? A lot of the time, it's down to what we call curve fitting. They don't realize when they're back testing a strategy that they're curve fitting it to the historical data, which may not work going into the future data as well. So that's another reason why traders who are looking to create specific strategies often fail as well. And when it comes to very short time frame strategies, so intraday, a lot of the time traders don't allow enough room for execution flaws, so execution slippage and spreads. They don't allow enough for that when it comes to short-term trading. Okay, so my observations are: worry less about win rate. Do a deep dive into overall profitability. Look for ways, actively look for ways to have solid risk-reward ratios. As I've just shown earlier on with the coin toss experiment, if you can actively look at it that way and look for good, solid risk-reward ratios, probably forgive your strategy a lot of the time. Even with a solid approach, you will still constantly need to work on your mindset. Doesn't matter if you've got a rules-based approach, whether you've got a robot trading for you, where you've programmed, doesn't matter. You're still going to have to work on your mindset, because even if your automated robot, which is trading for you, goes into a losing phase, you're still going to be affected by that. So you still have to work constantly on your mindset. And that's where I spend a lot of time myself with traders are working on psychology. And consider the road less traveled. What is the road less traveled? It's what we've been talking about here today. It's actively seeking low win rate strategies. Actively seeking low win rate strategies, but with much higher risk to rewards. And I say low, don't have to be super low, but lower win rate strategies, and look at overall profitability rather than win rate. That's the road less traveled. And here's a nice quote here: a trader with an average strategy but a strong trader mindset will always outperform someone with a better strategy but with a poor mindset. So again, it always comes back down to mindset at the end of the day. So someone with an average strategy which just ticks over doesn't make as much potential gain as someone with a better strategy. But the person with the better strategy, if they've got a poor mindset, they won't be able to trade the strategy so well. They'll jump out at times. They'll hesitate at times, all of that sort of stuff. Okay, we got some random charts now just to finish off with here, and then we'll come over to the questions. So these charts are just to give you a bit of a look at the this year ahead. We're into the fourth year of the presidential election cycle. We've got the elections over in the US coming in November of this year. This is the average for the S&P the average equity curve for the S&P during election years. So actually this yellow period, which is where we're at the moment, normally is a weaker period going down into, well, March and April. We haven't actually had that this year, but on average, historically, that's what's happened. But overall, what's happened with the S&P, historically, it's seen gains for the year overall. So anyone thinking that the stock markets might come down this year, they might do, of course, but history suggests that that is not going to be the case. Here's another one for you. So same data again since 1950. So this is from Fundstrat on Bloomberg. And we're looking at election years after a greater than 10% gain the previous year. Well, the S&P did what, 24% last year? So yeah, that's the darker line. So again, normally since 1950, we normally see a dip into the spring where we are right now, in spring of the Northern Hemisphere anyway. So into the March, April time, we haven't seen a dip in the S&P, in fact, this year. But nevertheless, what happens to the historical price of the S&P going into the end of the year? Generally speaking, it goes up. It has a bit of a wobble, prior to that election. So sort of September, October time might go flat or sideways or pull back a little bit. But overall, again, especially after following a greater than 10% gain the previous year, like we've just saw in 2023. And then lastly, I think this is a good one because there's been a lot of talk about the Magnificent Seven over this past year. Your Nvidias and your big tech companies driving stock prices higher. Well, if we take a look at the equal weight, this is provided by Carson Research, equal weight of the S&P ETF, the spiders, the SPY, and the equal weight of the, that is it, yeah, the Invesco S&P equal weight. RSP there. And so what it's showing us here is if we put it into equal weight terms, actually the rest of the stock market is not massively behind. So the blue line here, the Magnificent Seven at all. And so you put it into equal weight terms, and actually it's all pretty fine, because obviously those big companies have big weighting within the S&P. And so if you just put every stock in the S&P 500, giving it an equal weighting, then actually those Magnificent Seven stocks are not driving it all higher, which is a good, healthy sign for the broader breadth of the market there. And then one last one, if I got one last one, again here from Carson Research, showing as we're coming into the end of the first quarter, if you had a gain of 10% or more by the end of the first quarter in the S&P, then there's a 90% probability that the S&P closes the year higher. Okay, we're just on 90%, but we're just on 10%, at the moment, as we're nearing the end of this quarter. Just below it, actually, I think the S&P is at 9-point-something% up for the year so far. So we don't know yet whether it is going to quite do that by the end of this week. But if the S&P does go up by the end of this week a little bit more, then it will do that as well. So just a few charts there, just for a bit of fun, talking about, the historical information that we have and giving us a given probability of what stocks may well do this year. Okay, right. I'm now going to come over to your questions. So I thought we were going to get that done in 20 minutes. It took me 40, so my apologies for that. A little bit longer than I thought. So mean reversion, Lewis. Mean reversion is when, so what mean reversion is, so if you've got a let's just use something like a moving average. So if we use a moving average here, an MA on a chart, and price itself is going to move away from the moving average at times and then pull back to its average. The moving average is the price's average price, of course. So it will move away from its average price and it will mean revert back to it. So that would be a classic mean reversion approach. So people will look to sell when price moves away from its average. So look to sell when it moves it away from its moving average, and then look to profit and bank as it moves back to it. That's it's quite a dangerous, if you don't have risk management in place, then that can be very dangerous, because price actually can stay elevated away from its moving average for extended periods of time, and that's how people can get themselves into trouble. But that would be an example of mean reversion. Question here. Do I trade myself? Adrian, I've been trading 27 years. I said at the beginning, maybe you weren't here. I manage 5 different funds, and I still trade my own capital as well. So yeah, bit of a weird question to be asked, but yeah, there you go. There's your answer there. Yeah, no, it's not. It's fine. Right. What's my view on prop firms? You have a working experience, you said here, but not the capital. Most of the prop firms out there I don't like. I think you've got to bear in mind, they're businesses. They're in it for themselves to make money. So just bear that in mind. So by all means do it, but if you want to do it, but go into it with eyes wide open. They are in it to make money for themselves. So they will tell you what you want to hear, that, oh yes, well, we're just going to take a percentage of what you do, da da da. They know the stats. They know that traders, even the traders that pass their challenges, a lot of them will still end up rolling over in their equity at some point as well. So a lot of them historically have just had people running on demo accounts and stuff like that. There's nothing better than trading your own money. And I've heard horror stories about how they will get you stopped out, widen spreads and things like that. But by all means do it, but just bear that in mind. The best way would be to trade your own capital with a broker and put money into your own account and build it over time. Are algo bots reliable is a question here. Do I develop algo bots? In the main, no. It would be the simple answer there. So no, in the main. That's a simple answer. So if ever you come across anything on the internet, I would be very, very cautious towards that. Like I've said, I've been in this industry since 1997, which is when I started trading now. And I've seen it all. And if something sounds too good to be true, it usually is. So, and even if you had an algo bot trading for you, a lot of the time, from a psychological mindset perspective, doesn't make trading any easier. So I would encourage you to manually trade. Okay. Forex trading, I can see there's loads of questions coming through and I'll end up having to scroll up, but there's so many coming through that I'm just picking the ones that are at the bottom at the moment as they're coming through. So I will work my way back up, or by all means repost. Forex trading or futures trading, which is better? Well, they're different. Futures trading, I always think of futures trading as trading like the S&P or whatever, trading indexes. But of course, you can trade FX in futures, which I think is what you're possibly meaning. So I tend to trade spot FX when I'm trading Forex, but there's absolutely nothing wrong at all with trading futures. And if you're going to be holding positions for longer, then there's there's an argument for trading a future because you're not paying the overnight swap. So if you're holding positions looking to hold positions for months at a time, then certainly that's where futures really come into their own. Is studying price action important? Yes, it is. Yes, absolutely. Johan, you trade crypto and find that the only way to make money is using bots, but you put your own levels in and grids, not the AI ones, and on short periods based on 4-hour charts, win rate lasts 4 months, 40%. Perfect. That's what you want. Low win rates, high profitability. Yes. I'm scrolling up, but there's more and more questions coming through. What type of algo quants do Jim Simons use to make great returns? I wasn't saying that he was making returns of 50% a year, Alajid. I said that they had on many of their systems a win rate of 50%. But what types of quants do they use? They're never going to share that information, so we don't know. Not really, because that's what they invest millions and millions and millions of pounds in all of their programming in order to have that. So that's like top secret stuff. So you're never going to find that. Blair, no, actually, it's not just FX trading. So that has overnight fees. So you will have overnight fees if you're buying, for example, commodities, gold. You will have overnight fees if you're trading the likes of stock indexes as well, if you're doing it on a CFD. So yeah, there'll still be fees on most markets that you're trading, actually, if you're trading on a CFD, which is where many people do trade. I trade using CFDs. So yeah, it's not just FX. Yeah, but you can trade and use a futures contract instead. But a lot of the time, if you're just going to be in trades for a few days to a few weeks, it really isn't. The fees aren't that bad anyway, so it's fine. The overnight fees. Adrian, you're gonna trying to scroll back. Adrian, in your view, is day trading the most challenging? I ask as that's all I've been doing for approximately 10 years. Yes, I think day trading, Adrian, is the most challenging. The reason why day trading is most challenging is because of the psychological side of things, because you've got to deal with that constant temptation from the market. The market's moving around and you've got a 2-minute chart up and it's moving all over the place. And so you're having to deal with that constant temptation. Plus, you've got to deal with potential fatigue, mind fatigue as you go through the day. You won't feel tired yourself physically necessarily, but mentally you might suffer with fatigue as well. So are you making the right decisions at the right times? The potential to do things like overtrade are there a lot more so with intraday trading. So the emotions that you have to deal with. I used to intraday trade years ago, but the emotions that you have to deal with are far more magnified. So there's your answer on that one. Do I have book recommend? There's so many questions, and I really appreciate all your questions, but there's so many, I'm just having to cherry pick at the moment. Do you have book recommendations or a list of suggestions to read? Yes, I've already mentioned The Complete Turtle Trader. If you haven't read interviews, like the interviews from the 1980s with Paul Tudor Jones, then you definitely need to pick up some of the Market Wizards books, and do get Market Wizards by Jack Schwager, the original, and then there was the new Market Wizards that came after that, hedge fund Market Wizards that came after that, but go back and get the original. So Market Wizards, the interviews with the world's, at that time, most successful fund managers, it's not about trying to learn what their strategy is. They don't talk to you about stuff like that. What you're learning and what you're doing is tapping in to the mindset and the thought processes of those traders. That's what you want. That's what you're trying to learn. I'm never going to recommend trading books on some chap who's written a book on teaching you to trade. I'm not going to recommend those sort of books. I don't like that type of book. The best books on trading are ones that focus on your mindset. So Market Wizards are great books because really you're tapping into the mindset of those great traders. The Complete Turtle Trader is about that experiment and what went on when they did that. Of course, you've got things like Edwin Lefebvre's book. You've got, and of course, another mindset book would be something like Mark Douglas's book, Trading in the Zone as well. So there's a few for you just off the top of my head. Oh, there you go. Adrian's even said that, yeah. The coin challenge, you did on which time frame? It was on daily charts, Johan, and it would, like I said earlier on, it was done half an hour after the market open every day. So it was all tested on that, on executing 30 minutes after the market open. So it was based on that. Which is the most optimal time frame to trade on? Actually, I don't know. Overall, I don't think that there should be a most optimal time frame to trade on. The best time frame to trade on is the one that suits you the most. So what's right for you might not be right for someone else. Someone else might be a day trader, for example, so they're going to trade off of short-term intraday charts. You might have a full-time job and you're swing trading. So, a daily chart, or even, as you've just mentioned, a 4-hour time frame chart would be quite good. So for everybody, it's going to be different. If you're swing trading, you want to do shortish term swing trading. So from a few days to, a couple of weeks or so, then a 4-hour time frame chart is really quite a nice sweet spot, actually. So you can trade enough. There'll be enough activity going on, but you're not having to be there sitting there glued to the screen at the same time either. And you can work it around your other areas of your life. Is the quarterly theory a real thing in the market? And do you believe there are stop hunts and traps in the market? What are the best days to trade? What are your best Forex pairs to trade and why? Wow, that's a lot of questions all from in one. I don't know what the quarterly theory is that you're referring to, so I don't even know what that is. Do I believe there are stop hunts and traps in the market? No, I'm not a conspiracy theorist as such. Markets will gravitate to levels, okay? Because what is the market's primary function? It's to fill orders, okay? So it's to fill orders. It won't always fill orders, but and come back down for orders. But if there's a lot of orders at a given level, right away up here, and the market, as it comes up, well, no, it might go and fill all those orders up there only to then roll back over. It's not a conspiracy theory. It's just that's what the market is doing. It's there to try and fill orders. If there's a lot of orders all at a similar level, then the market might naturally move that way there. It's not a conspiracy theory. I have friends who work in the institutions. Do you really think the institutions are sitting there thinking, right, let's get these retail traders? some of their orders are down there. You're too small. You're too small for them to even care about pushing their market around just to try and get you stopped out. The market itself will just overall gravitate at times to certain order levels. But it's not going to always come back down for your order level. So don't worry about it. So just focus on, don't worry about getting stopped out. That's what stop losses are for. Focus on the times that your trade is working for you and getting a good solid risk reward when you are on your winners. Do you recommend 1 minute to 5 minute scalps? No, for most people, no, I wouldn't, Amar. I think most people should not go anywhere near an intraday chart. Most people shouldn't. More people lose at day trading than those who swing trade. Again, why? Because emotions. Because it's far more emotional, and so people who get into trading chase that side of things. It's much more dangerous for many, and we see it in the stats. Now, of course, again, there are a small percentage, of course, of day traders who are profitable. They're experienced, yeah. But would I recommend you to do it? No, not unless. Certainly, anyone who's been trading less than 2 years, I would not recommend to intraday trade and scalp, especially because it's too tempting. The emotional ranges are going to be too great, which means that you're more likely to have make a load of mistakes. So why put yourself in that situation? What are the best days to trade, and what are your best Forex pairs to trade, and why? Okay, I'm not a day trader anymore. I swing trade. So there aren't best trades today to trade, best days to trade, as far as I'm concerned, because it makes no difference to me. If I had to say to you, if you are intraday trading, and as I've already said, if you're trading less than 2 years, I don't think you should, but Mondays can be quieter. So Tuesdays, Wednesdays, Thursdays are usually better days to trade. And even I always found a Friday from an intraday perspective. But again, you have to be a bit careful on a Friday because it's end of week. You sometimes get end of month trading going on. You get triple witching and all sorts of things, options expiries coming in on the third Friday of the month as well. So you have to be a little bit careful on some Fridays. But I would say that. Now, as far as which are the best Forex pairs to trade, again, there aren't. I have my favorites, but that's just based on my overall style. So what's good for me might not be good for you. I spend most of my time trading the euro-dollar contract. Why? Because it's the biggest currency pair in the world. The euro-dollar, in a $9 trillion a day market, makes up 60%, roughly, just under 60% of the entire dollar index basket of currencies that are traded against the dollar. It's the biggest currency pair, or therefore the most liquid, so I trade that. But I will trade any of the major currency pairs. I tend to stick with the majors, but outside of that, there's not like, oh, one's better than another. It's what suits you and your trading style. Is there an amount too small to trade? Not overly. I mean, there is to some degree. I'd still say that, yeah, you would ideally a minimum of $1,000, let's call it $1,500, I would say, as a minimum. I know brokers will accept less, but it would be preferential to be trading with that. So you can trade with less, but my opinion would be as a minimum of that. But try and if you're going to be trading, then the more money, the better. Yes, once you're good at what you're doing, of course. But if you try and trade with like $200 in a trading account, then it's likely you won't even be able to trade at, the minimum size is going to put you at high risk anyway, because the minimum sizes are still going to be too much. Because realistically, where's my pen gone? You realistically only want to be trading at a maximum of 1% risk per trade of your account size. So if you've got $200 in your trading account, then you would only want to be risking $2 maximum per trade, right? Well, the minimum contract sizes would be, and if you're taking a trade and it's got, you've got to put your stop loss in, it's got 50 pips stop loss. Well, it would have you wouldn't be able to trade small enough to only be risking $2. So that's why. Johan, I think a lot of retail traders think that the market is just a playfield for institutional traders and forget that it's firstly about offer and demand, supply and demand. I think you mean that. Like gold, when gold is needed for a reason, countries buying. Yes, that's true. It reflects the price of people are willing to pay for gold. Yes. Yeah, I think it's more about the market is not some conspiracy. I think that's the main thing. I think a lot of people think that the market is out to get them, and it's just not that way. The market will, and the market will definitely do it to you. But it's a byproduct of the market's movements, and you're putting yourself into the flow of the market, and so it ends up just being a byproduct of the market movement. But yeah, hence why people need to have some form of training and approaches, methodologies, risk management, all of that stuff. That's why it's also important. How much time do you hold your average trades nowadays, Malik? Anywhere up to 3 months on trades. Yeah. You got to bear in mind, I'm a money manager myself now. And so I tend to be getting into trades on the various different funds that I manage. And I don't want to be trying to get in and out really within a couple of days. No, it's way too short a time frame nowadays for me. So I love the challenge of holding on, because that's actually quite a big challenge itself, is holding on to a trade. When you're in a nice profitable position and you could just bank the profit, but actually holding on to your designated, analysis targets. So, yeah. Could you share us a little bit of what you personally look for in the market, and what you look for when positioning for a trade? Yes, I will. I'll come back to that. Why do euro dollar, pound dollar, and Aussie dollar have the same price movements at times? Because they are all against the dollar. So they will move similarly. They have their own side of things. So, but they will move in a similar way, because they are all moving. The other side of the equation there is they are moving against the dollar. So they will move similarly there. So I will come back on sharing a little bit about, what sort of things I look for. So I'll do that in a minute. Yes, Johan, yeah, look at the percentages, not the actual dollar amount, especially if you're trading on small accounts. Yeah. If I'm trading, so the question here is, if I'm holding on to trades for months, on what time frames do I do my analysis? My time frames, why don't we go out to the chart here? So let's bring up a chart here. So I've got a chart of the S&P here. but I'll go out to a quarterly chart on the likes of the S&P or any market that I'm looking at, FX, whatever. So I'll go out to quarterly time frame, then the monthly, then the weekly, then the daily. So yes, multiple time frame analysis is what I'm doing. I don't know him, Adrian. Sorry, never heard of him. My apologies. You've got to bear in mind, I've been doing this 27 years. I'm not out there looking actively at what other people are doing. So I don't always know everybody. And he could be, I'm sure he's very famous, but I don't, I don't know. Too busy just doing what I'm doing. So, yeah. Again, you're saying, what's my favorite book about price action? I'm self-taught, Adrian. The only books I've ever read on the markets are trading stories like The Big Short or The Flash Crash, those sort of trading stories. Some of Ben Mesrick's stories on like rigged and ugly Americans, true stories. So true stories on trading, what's happened in the markets, and market psychology books, trader psychology books. I'm not interested in trying to teach myself in that way. I'm self-taught. I don't need to learn anything more. I'm happy with how I approach the market. How do you trade a small account? You trade a small account exactly the same way as you would trade a large account. It's just different numbers. That's it. Malik, to join my community, how much funding is required? There isn't. I don't ask you to. There's nothing. You're welcome to join my community, but it's not. I have traders with up to 33, 34 years experience. So I have highly experienced traders, and I also have people who have only been trading a year. So, yeah. Right. But I'm not here to talk about my community. I'm here to share with you some thoughts here this evening in conjunction with Tickmill, who are a fabulous broker. If you haven't tried them, just open a demo account with Tickmill and give them a try. They're really good. So well worthwhile. Even if you just go through an account opening process, and have a play with a demo account. They've got so many markets that they offer. So it's well worthwhile giving them a shot there. Yeah, exactly. The psychological mindset stuff you have to train. And this is what I was saying earlier on about the markets and the technical side of things. People, like I said, spend an inordinate amount of time on the technicals. Now, you do have to have a technical approach. Yes, you have to have a methodology. But Tobias, you've put yes, one of the best brokers, but you've just put it to hosts only. You need to share that to everyone. So of course you have to have the psychology, the technical approach, but it's the mindset that will make you over the long run profitable. Because like I said earlier on, you could have a technical approach, but you'll still end up mucking it all up if your mindset is wrong. And I've seen traders do that over and over and over again, which is why I spend most of my time talking about, I do technical sessions. We've done strategy webinar several months ago here with Tickmill. We've done a strategy webinar as well. But I really enjoy the mindset stuff because I know that's what really counts. Doesn't matter. I can teach someone a trading strategy, but it's going to be next to useless to them unless they have the mindset for it. So I prefer to be teaching psychology. Okay, sorry, coming back to your question. What's my opinion about Ichimoku clouds? It's just another approach to trading. It's just another method, of which there are thousands and thousands and thousands of methods. So I've looked at many of the main original methods, of which Ichimoku is one over the years. And for me, it was binned many, many years ago. But that doesn't mean to say there's anything wrong with it at all. It's just it didn't give me anything more than what I was already doing. So, but to someone else, it might do. So I'm quite relaxed when it comes to what people are doing. So now and again, people will say, "Oh, what do you think of this?" And I'll think, "Oh God, no, that's terrible." But like if someone says, I'm just going to buy when stochastics crosses," I'll be thinking, "No, don't do it." But there's a lot of things out there that you can use. And again, it's a personal thing. So what one trader likes, another trader may not. So but I don't have a particular view on that myself. Okay, right. Johan's called Tickmill Thickmill. I know that's just a typo there. Okay, so let's go through a little bit here okay, so how do I approach the markets? I have slightly different approaches with regards to stock index trading like the S&P here to that of FX. I'll use the same tools, but of course the stock markets tend to trend. Once they do start trending, they tend to trend for longer than sometimes than currencies. But it's the same thing. The bottom line is there's only so many ways to buy something. So if you're wanting to buy a market, you're either going to be buying, from a technical perspective, a breakout of a prior high, or you're going to be buying a pullback from a prior high. In essence, if you're trying to trade within a trend, then it's likely you're either going to be buying a breakout or you're going to be buying pullbacks. I do like buying pullbacks, but a lot of the time I will also try and trade down in a zone like this as well, and try and get in much lower down through here. So what I'm often trying to do is combine. If I zoom out a little bit now. So this is just on a daily chart. So this would be a typical sort of thing that I would be looking at. Overall, this was pulling back into November time of last year. So this would be a typical sort of thing that I would look at and say, right, what's my bigger picture view? This is just the daily chart. So what's the next time frames up? So what's my view on the weekly and on the monthly chart and even on the quarterly time frame? What's my big picture analysis? So if my big picture analysis is up for the weekly and for the monthly, and therefore most likely for the quarterly, then what I'm looking to do is to get long, on this pullback, during this pullback, in favor of the bigger picture. So the old line, fade the short-term trend in favor of the long-term trend. I'll say that again. Fade the short-term trend in favor of the long-term trend. So if the long-term trend you're identifying as being up, then you want to be using this downside move here to be looking for long side trades. So you're fading the short-term weakness here, i.e. doing the opposite of it. And that's a lot of what I'll do. And then it's just a case of entry techniques. So I'll use an entry technique on a pullback like this. Now it might well be that I'm also trading within a trend as it's moving up, and then looking at pullbacks within the trend, within this mini pullbacks within the trend there. But if there's a longer term pullback like this, then something that I'll use, something really simple, would be, I don't know if there was down there in this example, but if there was, would be a divergence. If you got two lows, 0.1 here and 0.2 here, and if we were diverging, I have an MACD down here. So if that was diverging down there, I can't quite see at the moment. I'm sat at an angle to my screen. So if that was diverging down there, then I don't think it was quite, I'll find another example. I think it was on the NASDAQ actually. Then I would then be using the divergence to get long in anticipation of a run to the upside. So that's a common thing that I will do. So I'll use the short term and then try and identify something like a divergence. So if I go to the NASDAQ now, no, there wasn't one on the NASDAQ. I take it back. There weren't. There was one on the Dow. Okay. So it was all the same pattern at the time. So the Dow down here, we can see the MACD blue line here was higher at 0.2 than at 0.1 down here. So there's 0.1. So we've made two lows, that low, we've come down, made a successive low, but the MACD is diverging from that. So that would be a typical thing, provided this is my, I've got a bigger picture view that the market, based on my higher time frame analysis, I believe that the market's going to be going up. Then I'm going to be looking for long side entries. And so if there is a divergence, I'll trade it down here. If there isn't a divergence, then somewhere during the trend and we get pullbacks within the trend, then I'll be trying to buy pullbacks within that. And I have a number of different execution strategies to get me in, but I'm just talking at a high level here this evening because we're already now an hour and a quarter into this webinar that I thought was all going to be over by in 45 minutes. But you guys just keep on asking questions, don't you? And I'm going to have to go soon because I need to have my evening meal and it's getting late. I use the standard settings for MACD. The standard settings for MACD are just 12, 26, and 9. So standard settings. The moving averages I've got on the chart here, I do use more than just these three, but I've removed some of the others. I do like moving averages. These are just the blue line is a 20, then a 50, and a 200. So that's all I've got there. And the main thing with moving averages for myself is I use simple moving averages, not exponential. And that's another topic in itself. Maybe the next webinar, maybe we'll do a webinar next month on moving averages and on using moving averages. There you go. So maybe we'll do a technical webinar next month. Oh, thank you, Aaron. Aaron's just said, Aaron, you've posted that to hosts and panelists and no one else can see that comment. Can you repost that, Aaron? And just change the drop down box to everyone so that others can see that. It's very kind. There you go. Otherwise people might be thinking I'm making it up. I don't want people thinking I'm making it up if I was reading out your thing there. So Aaron's kindly said he's been listening to me for years and my market analysis and wisdom there. Thank you very much. Last question then from Olu. Charlie, I'd like to join your community. Oh, okay. He's put it to everyone, so that's okay. And follow your analysis. How can you follow me? Just look me up. Just Google me, Olu, and you'll find me. Just Charlie Burton Trading, and you'll find me. But like I've said, I'm here in conjunction with Tickmill. I think they're a fabulous broker. I've got a really good relationship with them. I really like their team. And it's a real pleasure doing webinars for their customers and for their non-customers as well. And so, I do really enjoy coming along to these sessions. So I'm not here to really talk about my own community here. It's really just presenting a topic on the evening and trying to deliver something that if anyone here tonight leaves and just says, do you know what, there was one thing that he said that really resonated with me, then I've done my job. And on that note, I'm going to bid you good night, and wherever you are in the world, thank you very much for your time. And I apologize that I've not been able to answer all of the questions because there are so many and we'd just go on for 3 hours. So I would rather we stop it short and we look forward to the next one. Thank you ever so much for all of your attention there, and I'll see you soon.